Welcome to the Deep Dive. Today is December 4th, 2025, and we are completely bypassing the morning news cycle. Our mission today is to step right into the institutional flow, to find the real signal that's hiding under all the headlines. We're going to try and identify some actionable intelligence by, dissecting liquidity, looking at volatility, and pinpointing where correlations are just falling apart.
That's the whole objective. For you listening, think of this deep dive as a shortcut right into the institutional playbook. We're trying to extract those critical nuggets about positioning, especially where that trapped trader risk is sitting. And of course, the big one, the macro engine, which right now is, well, it's all about the market's aggressive bet on Fed rate cuts.
Okay, so if we're looking at the market right now, this very moment, how would you characterize the tone?
On the surface, you'd say sentiment is neutral. But if you peel back just one layer, what you see is a really complex, almost fragile consolidation. I mean, this momentum we're seeing, it's not coming from some big earnings surprise. It's all based on central bank anticipation. It's liquidity expectations, not fundamentals.
Fragile consolidation. I want to push back on that for a second. The S&P is holding up. The NASDAQ is rallying. Doesn't that feel more like solid momentum than fragility? Where's the hidden risk?
The risk is baked into the certainty the market is applying to what the Fed does next. But okay, let's start with where the money is moving first, the tactical playbook.
Right. And let's focus on that weird early morning window from about 4 a.m. to 9:30 a.m. Eastern. It seems counterintuitive, but why is that low volume period so important?
It all comes down to the liquidity profile. I mean, you have way less liquidity, wider bid-ask spreads. It means that smaller strategic institutional orders, the probing orders, can have this huge disproportionate impact on price. It lets them test key levels without showing their full hand.
And different indices have their own personalities, right, in these early hours?
Oh, absolutely. The ES, the S&P 500 E-mini, that's your benchmark. It's the balance point, moderate volatility. What we watch for there are these rapid moves on really thin volume. If the ES jumps 10 handles on almost no volume, that's not real conviction. That's an institution probing, maybe rehedging.
Then you have the NQ, the NASDAQ 100. That's the high beta, riskier cousin.
Correct. The NQ gives you these exaggerated moves. And what the institutional desks are watching for is divergence. If the ES is flat but the NQ is up 0.5%, that's conviction in tech. But if the NQ is lagging while the ES rallies, that signals they're distributing tech shares, or at least hesitating.
And for a broader market health check, we look at the small caps.
The RTY, the Russell 2000, it's very high volatility, and it's probably the purest tell for risk appetite. If RTY suddenly gets a lot weaker than the ES and NQ, it tells you investors are pulling back from speculation. A bad sign for the broader recovery.
Okay, let's talk about the institutional specialty. The trap and the grab. A trap trader is someone stuck in a losing position, and the liquidity grab is the exploit. How do we spot it?
It's all about precision and speed. Institutions will execute these really aggressive, sharp price sweeps to break an obvious level. Think the overnight high or yesterday's low. They know exactly where the retail and even some less sophisticated institutional stops are clustered.
They're just running the stops.
Precisely. They create a false breakout, a quick sweep that might only last a few seconds, and it comes with this huge but very short-lived volume spike. That spike confirms they got their large orders filled by triggering all those stocks. And then, crucially, you get this immediate snapback reversal in the opposite direction. The breakout buyers are now trapped.
So for anyone watching the tape, the metric isn't the size of the move, it's the speed of the reversal. The move has to fail, and fail fast.
Exactly. If it holds for 5 minutes, it's a real breakout. If it squeaks the high and is back below it inside of 60 seconds, that was a grab.
Okay, that moves us from the tactical chess game up to the big picture. What's the macro engine that's driving literally everything right now?
There's no debate. It is the relentless, aggressive anticipation of Federal Reserve monetary easing. That is the single thesis everyone is positioning for.
And how confident is the market in this? What are the numbers the bond desks are watching?
Extremely confident. I mean, the market is pricing in something like an 89% probability of a 25 basis point cut next week, December 9th and 10th. But just as important is the recent end of quantitative tightening, QT. That stopped a major liquidity drain from the system.
Can you break that down a little? The difference between the draining stopping and the easing starting.
Yeah.
QT can feel like jargon.
Sure. So QT was the Fed shrinking its balance sheet, letting bonds mature without reinvesting the money. That process literally removes dollars from the financial system. When QT ends, that drain just stops. So the market sees the drag on liquidity disappear and at the same time sees a high chance of rate cuts active injection and views it as this massive pivot.
And this is obviously hitting the currency markets. The U.S. dollar index, the DXY, is getting weaker.
It is. The conviction that U.S. rates are peaking has pushed the DXY down about 1.39% in the last month. It's sitting around 98.815. And a weaker dollar, it just tends to support global risk assets. It reinforces that risk-on feeling.
And the bond market is playing along. Lower rates, lower yields.
Yep. The benchmark 10-year Treasury yield has been trending down. It's around 4.09% now. Lower yields just reduce the opportunity cost of holding stocks. It's the justification for the rally.
This is where things get a little weird, though, the correlation breakdowns. This one single macro driver is messing with all the traditional relationships.
It's forcing assets that are usually opposites to move together. I mean, traditionally when stocks rally, a safety asset like gold should fall, or at least tread water. But we're seeing gold rally right alongside equities.
Gold is near a 6-week high, $4,210 an ounce. So why is a safe haven acting like a risk-on asset?
Because it's not a flight to safety right now. It's a hedge against future monetary policy. Gold is rallying because of those easier money expectations and the weak dollar. Investors aren't buying it because they fear a crash tomorrow. They're buying it because they fear currency debasement if the Fed eases too much. It's an inflation hedge right now, not a risk hedge.
And what about Bitcoin? It's supposed to be digital gold, an uncorrelated asset. It's behaving like the exact opposite of that.
It absolutely is. Bitcoin is just acting like a high beta risk asset. It's basically leveraged NASDAQ at this point. The correlation has been super high, near zero point 0.8 since early this year. You saw it on December 1st. There was a small pullback and Bitcoin just tanked, only to roar back just as aggressively when risk came back on. It's just a pure barometer for liquidity.
Let's check the VIX. It's sitting pretty low, around 16.53. What's the term structure telling us?
The term structure is in a clear contango. So longer-dated futures are priced higher than the front-month ones. You've got December futures at 16.55, but January is up at 17.74.
Okay, so our audience knows what contango is. What's the actionable takeaway from this specific curve right now?
It signals near-term complacency. The market is pricing in a pretty smooth ride for the next month or so, but that upward slope also implies let's call it a healthy degree of caution for the longer term. Participants expect volatility to eventually go back up towards its historical average, which is closer to 19. If this curve started to flatten, or worse, flip to backwardation, that would be the fire alarm for immediate stress.
Okay, let's pull on that thread. The structural risk. The market is pricing in a smooth ride, but where is the fragility? Where is the consensus getting it wrong?
I think the main overlooked risk is sticky core inflation combined with what's coming down the pike fiscally. I mean, the Fed's target is 2%, but core CPI is stuck near 3%. And on top of that, the incoming administration's agenda, whether it's tax cuts or higher tariffs, is widely expected to be inflationary.
And that inflationary impulse is on a direct collision course with that 89% chance of a rate cut the market's baking in.
Absolutely. And you have to remember, the Fed itself is divided. They've already cut twice this year, but the officials are not on the same page. They were recently making decisions while driving in the fog because of data blackouts. Their reaction is just not predictable.
So if you're an investor positioned for this aggressive easing, what's the pain trade? What's the thing that could really hurt?
There are two big ones. First is just a more hawkish Fed next week. If the FOMC comes out and says, look, core inflation is still 3%, we're pausing, or even just signals a slower path, you'll see a violent repricing in everything: tech, bonds, the dollar.
And the second risk is about crowding.
It's the reversal in crowded trades. This rally has been led by a very narrow group of stocks AI names, some software companies. The long positions there are extremely concentrated. If a little profit-taking hits a few of those key mega-cap names, the unwind from leveraged positions could cause some serious widespread pain.
It sounds like the market is just completely underestimating the inflationary impact of fiscal policy that's already in the works.
That's the blind spot. That stimulus could easily force a higher for longer scenario. And there's another risk bubbling under the surface in the credit markets.
You're talking about the BB-rated corporate debt. What's the scale of that problem?
Well, the institutional analysis we're seeing shows that for BB-rated companies that have to refinance their debt in 2025, their costs are going to jump by 180 to 200 basis points. This isn't a small increase.
Cool.
It's a systemic strain on their balance sheets that's going to start hitting in Q2 of next year. That could easily trigger some defaults.
Okay, so let's pivot. How do the top-tier institutions actually navigate this? How do they generate alpha in this kind of fragile environment?
They systematically harvest the volatility risk premium, the VRP, but they do it defensively. The whole idea is based on the gap between implied volatility, what the options market thinks will happen, and realized volatility, what actually happens.
Implied is almost always higher.
Well,
So the strategy is to sell that premium.
exactly. Selling out of the money calls and puts on indices like the S&P 500, usually in that 1 to 3 month tenor, that's where the premium is richest. It generates a consistent income stream.
But selling volatility is famously like picking up pennies in front of a steamroller. What's the insurance policy?
It's non-negotiable. You have to have strategic, long convexity protection. Deep out-of-the-money positions that pay off big in a sudden crash. Think long-dated VIX calls or deep OTM index puts. That insurance is what lets them collect that steady income from selling premium while protecting the whole portfolio from a black swan event.
Let's end with the key pivot levels, the numbers that tell us the whole story has changed.
Okay, for the S&P 500, a sustained break below 4,600 would be a major warning sign. That signals systemic stress. Below there, institutional desks start aggressively de-risking. On the upside, a break above 5,200, especially if market leadership broadens out, would tell us that the consolidation is over and we're back in a sustainable growth phase.
And for volatility, the VIX.
A sustained move above the 22 to 25 range. That's the regime shift. That's when complacency is officially dead, and you shift from harvesting premium to actively defending your book.
And finally, the anchor for everything, the 10-year yield.
A sustained break above 5.00% to 5.25%. That would be the signal of a major inflation scare, or possibly even a fiscal crisis. In that world, you'd see stocks and bonds falling together, which is the nightmare scenario for allocators.
So to wrap it all up, the force driving markets isn't earnings, it's liquidity, all driven by the near certainty of a dovish Fed. And that's created this fragile, risk-on environment where the subtle cues, the liquidity grabs, the in-queue divergence matter way more than the headlines.
And the most critical thing for you to take away is that this positive correlation we're seeing between things like gold and equities, it's not normal. It's a temporary alignment caused by this one single macro driver. The moment that expectation about Fed policy shifts, that correlation will break.
So here's the final thought. With the market pricing in an almost certain rate cut next week, what happens to the entire global asset structure if the Fed, citing that sticky 3% inflation or the looming fiscal pressures, decides to surprise everyone by sounding aggressively more cautious? What potential tail risks are you overlooking in your portfolio right now? We'll let you think on that.